Well, the Fed rate hike was expected. There are another 200 basis points already priced into the market, Scott, as you know. I think that will definitely have an impact on the demand side of the equation. But what about the supply side? It doesn't, Fed's hiking policy rates isn't going to put more truck drivers on the road or make Russia not invade Ukraine or create no COVID policies, zero COVID around the world. It's not going to fix the supply side. So I don't really think the Fed rate hikes are doing enough. I think the balance sheet, it's going to start in June. That maybe could help calm down inflation, but we still have all these supply side issues still ongoing.
Do you think the Fed can pull this off? And by pull it off, I mean engineer a soft, or even as the chair himself said, a soft-ish landing?
It's hard to say. I'm not sure. We've never had, this type of health crisis, which has caused so many secondary inflationary impacts. And at the same time, we've had so much fiscal spending, and the debt bubble has just grown around the whole world. It's not just the U.S. And I think the problem for the Fed is that you have some central banks very dovish and not reacting. And the U.S. dollar has been pretty strong. And I think the question is, the Fed is not alone in the global economy. And I don't think the rate hikes are still going to solve the inflationary pressures that we have on the supply side.
But what about this idea of what David Tepper was talking to me about, this credibility issue, not only with the U.S. Federal Reserve, but now the BOE does nothing to help its cause, as you said, the dislocation between where central banks in the world are. And I think of you at times like this because you see what happens in the bond market and the level of volatility that occurs as a result of all of this. It plays right into your wheelhouse. Do you expect interest rate volatility to continue as a result of that?
I do. So the Fed reducing the balance sheet, the quantitative tightening, I think is very bullish for bond volatility, for rate volatility, and that is what we specialized. It has been ticking up this year. There's actually a pretty big gap between equity volatility and rate volatility, but I think that makes a lot of sense on the fundamental side because we've never had, you just think today is May 6th, it was May 9th when the Fed stopped buying bonds, right? They were still doing QE less than 2 months ago. Now letting the balance sheet roll off in June, I think is just I think it's a good time to own some fixed income volatility and as a diversifier in the portfolio because we've never seen this. The quantitative tightening coupled with tighter policy growth rates at the same time.
You say it's now's a good time to own non-correlated assets. Explain exactly which and what you mean by that for viewers who don't follow your work all that closely.
Yeah, thanks, Scott. So what I mean by that is not corporates, right? If you own a company's stock and a company's bond, even though it's a stock and a bond and it looks different on paper, it's still the same company, right? You're still subject to earnings, profitability, costs. If that company has, say, higher labor costs or higher supply side issues or maybe higher chip prices or even a chip crisis, all those things can impact the company's bottom line. And whether you own the company's debt or the company's stock, you're just in different parts of the capital structure of the same corporate risk. So that's why we're so excited about providing access to a different market, which is the interest rate markets. And most people have exposure to interest rates, even though they might not necessarily realize that. And that's from their property prices, because so much of the property market is hinged on borrowing costs with mortgages.